The magnificent 7 stocks, Apple, Amazon, Google, NVDA, Microsoft, Meta, and Tesla, they were up a total of an average of 105% last year, pulling up the S&P 500. By this point of time, which of them are still cheap and which of them are too expensive to invest in? Let's find out in this video. Now, the Magnificent 7 are the 7 most dominant stocks in the US market, and they were the ones that pulled up the S&P 500 last year. Just take a look. Last year alone, NVIDIA gained 246%, Meta 183%, Tesla 129%, Amazon 77%, Microsoft 58%, Alphabet or Google up 56%, Apple up 54.8%, versus the S&P 500 that was up just over 21% last year. Now, we know that without a doubt, these 7 are great companies that will continue to dominate and grow over the next 10-20 years. But the question is, currently, are they too expensive to add more shares? Or are they so expensive that one should sell their shares if you're already sitting on a big profit? Well, let's do a quick valuation on these 7 stocks. As an investor, one of the most important skills is to be able to value a stock, to know is it expensive or is it cheap, because we can't tell by looking at the share price. A $500 stock could be cheap and a $10 stock could be expensive depending on the intrinsic value. There's an old saying that says a great business can be a bad investment if you pay too high a price for the shares, but a great business becomes a great investment if you can buy the shares at less than what it is worth. But of course, the most important question is, how do you know what is it worth? Now, there are many methods to value a stock. You've got the simplest methods like the price to earnings ratio and the forward PE ratio. And you also have got methods like the PEG ratio and a more comprehensive method, which is a discounted cash flow method. And let's run through all these methods. And you find that they will all give you slightly different results. And I'll share with you which I think are the most reliable results. So the simplest way to value a stock, which most investors use, as you guys know, is called the price to earnings ratio, or we call it the PE ratio. So this is calculated by taking the current share price and dividing it by the earnings per share over the last 12 months or the last financial year. And generally, the lower the PE ratio, the cheaper the stock is. Now, PE ratio by itself can be quite misleading. Do check out my YouTube video on why PE ratios are misleading. I did an entire video on PE ratios, but they are the simplest method. Now, the second method is what we call the forward PE ratio. So this is called forward price to earnings ratio. So what's the difference? The difference is that for the forward PE, we are still taking the current share price, but we are dividing it not by the earnings of the last 12 months. We are dividing it by the forward earnings, which are the projected earnings of the next 12 months. Now, when you're valuing tech stocks, especially with high growth rates, the earnings next year are going to be a lot higher than the earnings last year. So since we are valuing the stock based on future prospects, it makes sense to divide the price by the future earnings, which are projected the next year. So that's called forward PE. The third method is called the PEG ratio, which was developed by Peter Lynch. Now, the PEG ratio basically takes the PE ratio, which is the first one. We take the PE ratio and we divide the PE ratio by the projected growth of the company, earnings growth, over the next 5 years, roughly, right? So if you take the PE ratio divided by the earnings growth of the next 5 years, that gives you the PEG ratio. So again, the lower the forward PE ratio, the cheaper the stock is. The lower the PEG ratio, the cheaper the stock is. So where can we find these ratios? Where can we find the forward PE based on the earnings of the next 12 months? Where can we find the growth rate to calculate the PEG ratio? There are many websites you can go to. I'm just going to go to 3 websites. And you may find that different websites, they have got slightly different projections, growth rates. So I like to take an average of at least 3 different websites. So the first website would be finviz.com. The second would be gurufocus.com. And the third would be FinChat. So let's take a look at NVIDIA, for example. NVIDIA is up over 225% last year and up another 15% this year. So a lot of people are thinking, is it too expensive? Is it too high? Can I still buy? Well, let's find out based on the three ratios, right? So let's begin by going to FinViz. So if you look at NVIDIA, what is the current PE ratio? It is 72, which looks, oh my God, really, really high, right? But remember that the PE ratio is equal to the current share price today divided by the earnings per share last year, last 12 months, last financial year. So if you divide it by the earnings last year, which was 2023, yes, then it looks very expensive at 72. And a lot of retail investors would see this and say, you know what, it's too expensive, forget it. But again, remember that NVIDIA is a growth company. And this year, 2024, their earnings are projected to grow at 267%. So a more accurate way to value it would be to take the current share price, and instead of dividing by last year's profits, which is already over, we divide it by this year's projected profits, which is the earnings in 2024. And this will give you the forward PE ratio, which is over here at 26 times earnings, which now doesn't look as expensive. Now, some of you may think, but Adam, this projection of 267% is just a projection. It may not actually happen. It's just an estimate, right? Correct. And that's why we have to look at multiple websites to get an average of the different projections, because they could all be a bit different. So if I look 3 different websites, I get 3 different forward PE ratios. I take an average of 3. So for example, on FinViz, what's the forward PE? Is 26.7. Let me just write it down somewhere. 26.37. Now let's go to another website, which is GuruFocus. And on GuruFocus, you can see that their forward PE for NVIDIA is 28.1, which is higher than FinViz because they are probably using a slightly lower earnings growth projection this year. Hence, the forward PE is a bit higher. So let's write it down, 28.1. And let's go to a third source, which is FinChat. If you go to FinChat, you can see that the next 12 months, NTM means the next 12 months, PE ratio or forward PE ratio, same thing, is 28.13, which is similar to GuruFocus, so 28.13. So what I then do is I take an average of these 3 to get the ratio. So if you take an average, you get 27.53. So that will be the forward PE ratio that I'm going to use for NVIDIA. All right, so let's recap. We have got the PE ratio, which is 72. We've got the forward PE ratio, which is 27.53. Now the third metric that we can use to value a stock quickly is known as the PEG ratio or the PEG ratio. So the PEG ratio is equal to the PE ratio divided by the growth rate of the earnings for the next 5 years. Now, do we know the PE ratio? Yes, the PE ratio is 72. So we take 72 and divide it by the growth projection of NVIDIA. Now, what's the growth projection? Again, different websites, different rates. So let's take a range from the lowest growth to the highest growth. So where can we find it out from? Over here. So first on FinViz, the growth rate for the next 5 years is earnings for the next 5 years. They don't give it on this website. So let's skip. Let's go to the second website, which is GuruFocus. And on the bottom right, there we are. Future earnings growth rate is 50%, 50.35%. And on FinChat, you can see the earnings per share long-term growth is 42.37. So 42.37 low end, and the high end is 50.35, right? So let's write this down. So growth rate is from 42.37 to 50.35. That is the estimated growth range, okay? So how do we calculate the PEG ratio? We take 72 and divide it by 42.37, and that gives us a PEG ratio of 72 divided by 42.37. That gives us a PEG ratio of 1.7. Now, if we divide it by 50%, 72 divided by 50%, or 50.35, that gives us a PEG ratio of 72 divided by 50.35. That gives us a PEG ratio of 1.43. 1.43. So in other words, for NVIDIA, we can say that the PEG ratio is between the range of 1.43 to 1.7. All you got to do is to do the same thing for the other 6 stocks. Don't worry, I've done it for you, so you don't have to do it. And I've put it all on a table. Ready? Let's check out this table. Okay, there we are. So these are the Magnificent 7. I put down their PE ratio, the forward PE, and the projected growth rate from the 3 different websites, from the lowest growth estimate to the highest growth estimate. I calculated the PEG ratio by dividing the PE ratio by the growth projection for the next 5 years forward. So based on this, which is the most expensive stock in the Mag 7 and which is the cheapest? Well, again, it depends on which metric you're using to measure it. So if you measure it using the forward PE, boom, there you are. Based on forward PE, the most expensive stock is Tesla with a forward PE ratio of 62 times earnings. And the cheapest stock is Meta with a forward PE of 21 times earnings. And the rest are in between. So from Tesla, the second most expensive is Amazon at 42 times earnings, Microsoft at 33 times earnings, NVIDIA 27 times earnings, Apple 26.9, Google 21.7, and Meta at 21 times earnings. So that's the list based on forward PE. How about based on PEG ratio? Now, if you base on PEG ratio, again, let's arrange it from the most expensive to the cheapest, and we get this, which is pretty similar, except now Amazon looks like it's the most expensive because Amazon has got a PEG ratio of 3 to 5. And again, the higher the PEG ratio, the more expensive. The lower the PEG ratio, the cheaper. But Meta is still coming out the cheapest at only 1.03 to 1.3 PEG ratio. Second most expensive is again Tesla, which was the most expensive using forward PE. Next, Microsoft, Apple, NVIDIA, and Google. Now, the limitation of using PE and PEG ratio is that it just tells you whether the stock is more or less expensive compared to other stocks. But it doesn't tell you the actual intrinsic value of the business. So you know how overvalued and how undervalued is it based on its own business. And at the same time, using earnings per share has a lot of limitations because very often a company's earnings can be misleading. What is more important is to look at the company's free cash flow, how much cash flow it actually generates from its business operations. And that's why for me, in my Whale Investor course, which I teach at piranhaprofits.com, and my Wealth Academy Investor Masterclass, I show my students how to do a discounted cash flow valuation or discounted net income valuation to get a more comprehensive idea of what is the actual intrinsic value of the stock. And you have to also understand the business well to know when to make certain adjustments, to take out exceptional expenses or extraordinary income so you get a more normalized free cash flow that gives you the most accurate result. So I'm going to show you a few examples of how I do it right here. And of course, if you want to learn this, do take the Whale Investor course. The intrinsic value calculator comes with the course. And of course, if you're very lazy, you can subscribe to the UIP where I do all these valuations for you on a regular basis, right? But let's jump in. I'm going to show you how I value some of these stocks right now. So this is the intrinsic value calculator. And currently, NVIDIA's share price closed at $547 last week. So what is the actual intrinsic value? And is it now overvalued or undervalued? Well, let's check it out. So one of the things is we want to find out what is the current free cash flow that the business is generating and project it for the next 20 years. And we're going to discount that to present value. Now, unlike most analysts where they project the cash flow to perpetuity and use a terminal value, I just use 20 years. I'm a lot more conservative, and that's why I don't use the weighted average cost of capital as my discount rate. For the discount rate, I use the cost of equity, which is using this formula over here. Based on the beta of the stock, I will select the appropriate discount rate. Again, this is my own proprietary method of valuation that has worked very well for me over the last 20 years. So I know it's accurate, right? Okay, good. So for NVIDIA, what is the current free cash flow? Well, you can go to Yahoo Finance. Let's go to Yahoo Finance. And if you look under the cash flow statement, you can see that the last 12 months, NVIDIA's free cash flow is 17.515 billion, or 17,515 million. Okay, so that figure over there, plug it into the calculator. There we are, 17,515 million, right? Then you put in the total debt of the company and the cash and short-term investments they have on their balance sheet. Then the next thing is to put in the projected growth rate. Now recall earlier on what was the growth rate that we found for NVIDIA. The growth rate range was, what was the growth rate range? Let's open it up. There we are. The growth rate range for NVIDIA is 42% to 50%, right? That's the range. So we're going to take the lower end of the range. Let's just take 42% growth. And if you do that, we just put it in. Yep, 42% growth for the next 5 years. And for the following 5 years, I always put a cap of maximum 15%. That's my convention. I don't go above 15%, right? And for the last 10 years, I assume that it just grows at 4%, which is GDP plus, okay? And I do that for most stocks. And if you put in the number of shares of NVIDIA, that will give you an intrinsic value of, ready? The answer is $564.94. There we are. So that is the intrinsic value of NVIDIA. So based on the last market price of 547, you can see that NVIDIA is actually 3% undervalued, right? So even though the stock went up 250%, it's still not expensive based on this projected growth rate. So let's calculate the intrinsic value of Tesla. So first we have to find out what is the projected growth of Tesla in the next 5 years and beyond. So again, let's go to those websites. So the first website again is Finviz, and you can see that for Tesla, the 5-year growth projection for their earnings is 1.8% on this website. So let's write it down, 1.8% growth for the next 5 years, which is quite low, which is, I don't know how they got that number. But let's go to another website to get a second opinion. Let's go to Guru Focus. And on Guru Focus, you can see their projected growth rate for Tesla over here is 24.42%. So let's write that down, 24.42%. And finally, let's look at FinChat. FinChat, this is again Tesla. Their 5-year growth projection is 16.8%, right? So 16.8%. Now, usually when I get growth rates from 3 different websites, if there's one growth rate that is an outlier, which is very different from the rest, I just ignore it, all right? So let's ignore the 1.8%. I think that's a bit too low. So I think an appropriate growth rate is between 16.8% to 24.42%. That will be our growth range. Now let's pull out our intrinsic value calculator for Tesla. All right, and there you are. Okay, so you can see that for the growth rate for Tesla, I've put in the higher end of the range, which is 24.42%. 15.42%. Now, of course, you can put the lower end of the range, which is 16.8% if you're more conservative, but I decided to just put 24.42% to begin with, right? So that's for the first 5 years. And just like NVIDIA, for the next 5 years, I kept it at 15%. I keep that as standard. And for the last 10 years, I just put in 4%, which is GDP plus, GDP of the economy and plus about 2%, right? Okay, now then the next thing is we have to put in what is the, now usually I use a discounted free cash flow where I put in the free cash flow of the company in the last 12 months. Now for Tesla, the problem is if I do that, the intrinsic value becomes too low. And let me show you why. If I pull out the financial statements of Tesla, right? And you go to Tesla, cash flow statement, you can see in the last, the last 12 months, what is the free cash flow? The free cash flow is only 3.7 billion, 3714. Now, if I put that in, what's going to happen? It's going to be too low an intrinsic value, right? If I put 3714, what happens? 3714. Yeah. My intrinsic value is only $56, which is a bit ridiculous, right? Because right now Tesla is selling at $218, so $56 is just too low. And one of the reasons is because Tesla, like many manufacturing companies, the cash flow tends to be very inconsistent. So you can see their free cash flow from 2.7 billion to 3 to 7 to 3. So it's very choppy. So in that case, we can't really use free cash flow to do an accurate projection. You have to use something that is more consistent, that is smoother, right? So because of that, I decided to use the net income of Tesla. So if you open it up over here, you can see the net income of Tesla is 10.7 billion, right? So I decided to use this 10.7 billion instead of using 3 billion, which is too low. And even if I use the free cash flow the previous year at 7 billion, that's low as well, right? So I want to be a bit more optimistic with Tesla, since some of you say I'm not very positive. So I'm going to be very positive. I'm going to be very optimistic and say, okay, let's put in net income of 10.738 million, right? 10.738. Okay, so let's put that in. 10.738. Boom. Okay, so that gives us an intrinsic value of $151, right? So you can see that even when I put in the more optimistic growth of 24% at the higher range, even if I put in a net income of 10 billion, which is a lot higher than free cash flow, my intrinsic value only comes up to $151. So at the current share price of $218, it's telling me that, you know, Tesla is overvalued by 45%. So that's the reason why I'm more comfortable investing in NVIDIA today than Tesla. Now, I can go through the intrinsic value calculation of all 7 stocks, but we just don't have the time. We're running out of time, so I'm just summarizing everything on this table based on my own valuation. And I made adjustments here and there based on my understanding of the underlying business. So like I said, for Tesla, instead of using free cash flow, they'll make the valuation too low. I decided to use their net income. And for example, for Amazon, I also do not use their current free cash flow, because in the last 3 years, their capital expenditures or capex have been abnormally high as they built out their fulfillment centers. Right now, Amazon has gone to the end of their capex spend cycle, so their capex should normalize back to the 2020 level. So I'm taking the current operating cash flow minus 2020 capex to get the normalized free cash flow for Amazon. So just so you know, there are a few adjustments along the way. So based on that, I've summarized it on this table over here. And you can see that, for example, Tesla is selling at a 44% premium to its intrinsic value, whereas Apple is selling at a 9% premium to its intrinsic value. Microsoft also 3% overpriced, but NVIDIA, Amazon, Meta, and Google are currently still undervalued. Google is currently the cheapest of the 7 stocks. It is 22% undervalued right now. Now again, if you want to learn how to calculate your own intrinsic value using my calculator, you can take my Whale Investor course at piranhaprofits.com. You can enroll in the course, or my live Wealth Academy Investor Masterclass. Or you can subscribe to the Ultimate Investors Playbook, or UIP, where I do all these valuations for all my subscribers regularly. So I do all the work for you. You just have to look at the analysis. Now, bear in mind something. Just because something is the cheapest, it does not mean it will go up the most, because it's not just about whether it's undervalued, but it's the quality of the business. And that's what I'm going to be talking about in the upcoming Market Outlook event 2024. I'll be doing a live event in Singapore Marina Bay Sands on the 20th of January. That's live in Singapore. But I'll also be doing an online webinar on my outlook for 2024. And in that outlook, I'll go more into detail on the tailwinds as well as the headwinds of these mega 7 cap stocks, as well as many other stocks that I think I'm going to focus on for the coming new year. So a lot more to learn. This is just the beginning, and I hope you found it useful, and I hope to see you at the Market Outlook event really soon. Take care. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.